Okay. So this is basically you have to pass the journal entries when a limited company is taking over a partnership. So when a limited company takes over the partnership firm, what happens is the partnership is going to dissolve. And in that case, we have to make a partner's capital account. So if we are making the partner's capital account, we should know what are the things that will come in the partner's capital account. The first thing that you will do is when you're making the partner's capital account, you will have two partners, say A or B, and the limited company is taking over your partnership firm. That means the firm has to dissolve. If the firm has to dissolve, that means the partner's capital account will no longer exist. Partner's capital account or partner's current account, they will no longer exist. So in that case, if you have to prepare a partner's capital account, first thing you will do is if you have any partner's current account balances, you will transfer it to their accounts. Second thing you will do is you will deal with loan from partners. When I'm talking about you will deal with loan from partners, that means that the limited company is going to give some percentage debentures to those partners who has given any loan to the partnership, and they will give percentage debentures in such a way that the interest on debentures will be equivalent to the interest on loan. So you have to deal with the loan from partners by calculating the amount of debentures that you will issue to the partners. Then you will open the realization account and you will transfer any profit or loss on realization to partners capital account. If there is a profit on realization, it will come on the credit side of partners capital account. If there is any loss on realization, it will come on the debit side of partners capital account. Okay, and then you will identify how much each partner is entitled to take away from the dissolution. That means partners capital account will not have a balance closed down. Whatever amount you will get as balancing figure, either on the debit side or on the credit side, will be settled by way of cash or bank. So this is how you prepare a partner's capital account when you're doing acquisition sum. Okay, I'm sure this is very clear. Let's look at the journal entry for purchase consideration. So when I am passing journal entry for purchase consideration, my limited company is taking over assets and liabilities of partnership. So what will we do? All assets that the limited company takes over, we will take it under debit. All assets that they take over is called the NATO, net assets taken over. When you compare the net assets taken over with the purchase consideration, and if the purchase consideration is more than the net asset taken over, then what you get is called the goodwill. All our liabilities taken over will be credited, and whatever the limited company is giving to the partnership firm will also be credited as the purchase consideration. Let's pass the journal entry for purchase consideration in this sum. It's a textbook sum. Larkfield Limited has purchased the business of Muhammad, who is a sole trader. The non-current assets of Muhammad is here. Current assets of Muhammad is here. The capital of Muhammad is here, and current liabilities of Muhammad is here. The net assets that were taken over is valued at this amount. They have given us the net assets taken over. The total agreed value of the assets purchased by Larkfield amounts to 366,000. So The agreed value of the net assets that Larkfield is going to take over is 366,000. Larkfield Limited is not going to take over Mohammed's cash and cash equivalent. That means this is not going to be taken over. So these are not entered into the journal. Larkfield Limited paid Mohammed 500,000. So to take over these assets and liabilities, Larkfield Limited is giving Mohammed 500,000. This 500,000 is nothing but your purchase consideration, and purchase consideration is made up of cash 100,000 and 250,000 ordinary shares. Let's see the discharge of purchase consideration. Purchase consideration is 500,000, and this 500,000 is made up of 100,000 cash, 250,000 ordinary share capital of 1 each. So the balance 150,000 will be the share premium. Now I have to pass the journal entry to record purchase consideration. All assets taken over debit. So all assets that is taken over is debited. Assets taken over is 366,000 and purchase consideration is 500,000. When I compare the assets taken over with purchase consideration, what I get is goodwill. So the goodwill is 134,000. All liabilities taken over credit, purchase consideration credit. And this becomes the journal entry for purchasing the business. I hope this is very, very clear. This is one more sum where you have to pass journal entries in Bridge book to record purchase of Monty's business. That means Bridge is a limited company and he is purchasing Monty's business. Bridge is a limited company and he is purchasing Monty's business. That means Monty's business will close down and I have to find the NATO net assets taken over for Monty. Monty has his non-current assets, current assets, capital, current liability. This all is of Bridge. I don't care about this. It was agreed that Monty's assets will be valued at this amount. That means when they are taking over, the premises of Monty is valued at 190, plant and machinery at 55, office furniture at 19, inventory at 26, trade receivables at 13, and they're not taking over the cash and cash equivalent. Trade payables, I see there is no trade payables of Monty. Bridge Limited did not acquire Monty's bank account, and the consideration for the sale was 460,000. That means they are giving purchase consideration of 460,000. So the net assets taken over is 190 plus 55 plus 19 plus 26 plus 13 minus 18 of trade payables. This is the net assets taken over. For this, Bridge Limited is giving purchase consideration of 460,000. Let's see how much is the value of the net assets taken over. The net assets taken over is 285,000. The total of this minus trade payments. It's 285,000. For net assets taken over of 285,000, Bridge is paying Monty 460,000. So the difference between NATO and purchase consideration will become goodwill. So what is the amount of goodwill? Amount of goodwill is 175,000. How is the purchase consideration discharged? Purchase consideration is discharged 40,000 cash, 300,000 ordinary share capital, and the balance would be share premium. What would be the amount of share premium? 120,000. So the amount of share premium is 120,000. So the share premium is 120,000. So purchase consideration is discharged in such a way. Now I have to pass the journal entries in Bridge Limited books for purchasing Monty's business. So if I'm purchasing Monty's business, all assets that I've taken over will be debited. Goodwill amount will be debited. Goodwill amount will be debited. What will be credited? The trade payables will be credited. Trade payables has been taken over at what amount? Trade payables is not there only for Monty. Purchase consideration will be credited. So this is how I will pass the journal entries in the books of Bridge for purchase consideration. All assets taken over debit, goodwill debit, trade payables credit, and purchase consideration credit. Okay. Also, I have to prepare Bridge Limited statement of financial position immediately after the acquisition of Monty's business. So if I have to prepare the combined statement of financial position immediately after acquisition, I will add the NATO with Bridge. So Bridge Limited new statement of financial position that we will prepare. The non-current assets will be 190 plus 510. Plant and machinery 55 plus 133. Office furniture and equipment 19 plus 58. Inventory would be 26 plus 67. Trade receivable 13 plus 33. Trade payables will be 18. But I will write the ordinary share capital, which is 550,000, and I'm also issuing 300,000. So this will become 550 plus 300. So it will be 850,000 for ordinary share capital of 1 each. When I talk about the share premium, this 120 of share premium will also come. When I talk about cash of Monty will not come, but the cash of Bridge, that is 69,000, from that I will minus 40,000 of the cash that I have given for purchase consideration. Given for purchase consideration. Okay. Retained earnings will as it is. So I will get total capital. So this is how I will make the statement of financial position of Monty after acquisition of Monty's business, the statement of financial position for Bridge Limited. And the statement of financial position would look something like that. You don't forget that you have to subtract the cash. You have to subtract the cash. Also, do not forget that ordinary share capital has to be accounted for. Share premium has to be accounted for. Retained earnings will remain as it is. This is how you prepare the statement of financial position immediately after acquisition.